What's up, traders? Let's talk about sector rotation. Sector rotation has been one of my most popular videos on my channel, but I haven't made one in a year now. March of 2021 was the last one. And the reason is because the signals based on sector rotation have not been very clear. That's changed. Now the signals are very clear where the money is flowing in this current market cycle. The whole premise of sector rotation is that money tends to flow into and out of stocks based on the business cycle and the stock market cycle. And if we chart where we are in that cycle, we can get an idea what the next sector is that is going to lead the market, whether the market is going up or down. Always go back to this tool on stockcharts.com to look at the relative performance of different sectors. These are using spiders, the spider ETFs like XLY, XLC, XLK, relative to the SPX or SPY if it were. Now, what I've done here is I've gone back and looked at April 2020 to September 2020. Basically, the first 2 quarters after the COVID crash. And coming out of the COVID crash, two distinct sectors were winners. That was consumer discretionary and technology, basically things like luxury goods and tech. We all remember the tech was the big leader. And this really fit the sector rotation model because the theory would suggest that at a market bottom, which COVID was, technology and discretionary would lead us out of that market bottom and trigger a bull market. Communication services, industrials, and materials should lead in the following periods of the sector rotation. And then the market should top out with energy leading. Now, as the time went along, we're just going to slide this forward. We can see where technology continued to lead, industrials and materials began to outperform right around the middle of 2020, and they continued to perform. We had a big bullish period in energy, and I think a lot of people thought that this meant we were having a market top. But inexplicably, tech began to lead again. And at this point, the sector rotation model, being theoretical, kind of fell out of its prediction. It was not doing as we would think it would. But now, as we go into the last 2 quarters, it's becoming very clear what the winners and the losers are. Energy is definitely leading, especially if we go to the last quarter, the last 60 days, it becomes even more clear. Energy is definitely outperforming the rest of the S&P. Energy stocks like ExxonMobil, Chevron, etc., oil companies. But then something else interesting has begun to happen, which is why I'm making this video. Consumer staples, healthcare, and utilities are beginning to lead. Now, these are considered to be defensive sectors. To give a little narrative to it, people are going to buy toothpaste even if there's a recession. People are going to need to go see the doctor for healthcare even if there's a recession. And people are still going to need to keep their lights on and pay their utility bills in a recession. These companies and consumer staples, healthcare, and utilities tend to be value plays. They're not very speculative. They're not very volatile. They tend to be where money goes when it's feeling like it needs to be defensive. And this fits within the sector rotation model where energy leads at what could be the market top. And as the market begins to roll over, as we're seeing now, consumer staples, healthcare, and utilities are leading. And so if we begin to look at individual stocks in each of these sectors, we're going to see some are winners and some are losers. One recent trade that I posted on TradingView was Garmin, which is a tech company. It pulled back on earnings to a standard strategy that I use where I look to buy it on a 50% retracement level. It even gave me a earnings spike, but that stopped out. I'm okay with that. Waste management, on the other hand, was the same sort of setup. It was also a pullback to a 50% retracement, a technical level on this February 24th low that I'm sure we all remember, pegged it and went. It also gave me a nice little false breakout and then a rise. In fact, this is up about 11% from where I bought it. Waste Management is a utility company. And so it makes sense why technology plays are not working, but defensive plays like utilities are working. And that's why it's important to point this out, because just because the market is going down does not mean every single stock is going down at the same time. Some other things like Southern Company on a day like we just had today, which was March the 7th, 2022, market was down almost 2.5%, the S&P was. But companies like Southern Company, Duke, Power, these utility companies were up almost as much as the market was down, which is again the overperformance of these sectors, these defensive plays. A lot of these companies pay dividends. People would rather receive that dividend even if the stock price is going down. These are the reasons why the money is flowing into these defensive plays. Now, this is a bit of a lagging indicator because they are leading. We can see it. Perhaps the risk reward is not there quite as much anymore. So I'm not saying that we need to go jumping into these plays. But if you're looking to get defensive, or if you want to keep a laser focus on the sector that is winning, this can help you narrow down your search for opportunity even as the market is going down. There's a follow up to this. If we assume that the sector rotation model is going to continue as the theory suggests, then following the lead of consumer staples, healthcare, and utilities, we should see, as the market reaches a bear market, financials and real estate begin to lead. So that could come in the next few months and quarters. And we can see that while these are up relative to the rest of the S&P, financials and real estate are not outperforming quite as much. I really like this model because even while we had a bit of a inversion, as it were, during the COVID crash, and we can say any number of narratives to why that might be. Look at the S&P right now to close this out. The Fed printing money, artificially inflating companies' valuations, stock buybacks, whatever it may be. I still believe there's going to be opportunity out there in any sort of market condition. And this can help narrow your search to companies that might be winners even in a potential bear market. I don't think we're in a bear market yet. I'm looking to see us potentially break the February 24th low. At that point, I would consider it a bear market unless we do, excuse me. If we do, I consider it a bear market. Otherwise, I still think this was just a correction. That's my personal sentiment, but it may change, and I'll update you in videos to come. So, do yourself a favor, do a little bit of research into the sector rotation model to understand where the stock market is and where there might be opportunities. So, as always, I hope this helps you guys trade wisely. We'll see you in the next video.